It's my pleasure to share our thoughts with you over the next couple of minutes. Going forward, just for ease of communication, I'll refer to our trust as BEMO. That's also the ticker when you want to look it up. I just started, and I wanted to take you through the rationale of investing into BEMO. And for that, I think we need to start with defining, where we invest at BEMO. It's shown on this map, and it always captures my imagination. It's such a vast territory. But remind you, this is not very well represented in overall indices. It's very much, you can say, a sideshow from the global equity market point of view. We think it's, rather unjustified. And I'd like to present you some of the reasons why we believe this could be well, to the benefit of investors going forward. First of all, we see a vast opportunity set in the long-term potential of the region. And here I'd like to highlight the diverse nature of the economies and that the companies we invest in operate. So you get, of course, countries, countries that benefit from exporting raw materials and commodities, others import. You've got aging populations, very young populations. You've got the manufacturing hubs of the new EU member states. You've got emerging African nations. So it's a very diverse set that we operate in. We think by combining these different backdrops, we can build a suitable portfolio that is relatively resilient to global shocks. And it's best exemplified in the way these economies are growing and have been growing in the past. We can see that this is relatively uncorrelated to each other, firstly, and to global growth cycles, and that points towards the resilience that I was referring to. Secondly, we think that this undiscovered growth that I was highlighting, will suit a global investment portfolio quite well, especially when it also acts as an income diversifier. But that means that you don't necessarily, by investing into EMEA companies via BEMO, you don't necessarily have to sacrifice growth for income. And that's in the nature of the low valuation of quality growth stocks in this region that allow for a decent yield pickup whilst keeping a focus on the overall growth file. So yes, we are looking for quality growth companies in a high conviction strategy, in a focused, concentrated portfolio, but we can at the same time, we think, deliver income that is based on a very diversified and resilient, we believe, economic backdrop. This is all produced by an experienced team at Barings, while that also incorporates environmental, social, and governance factors in the stock picking process. The team is highlighted on this page, on this slide. I've got the honor to cooperate with Maria and Adnan as co-fund managers in this trust, and we are aided by our colleagues that help us analyzing companies on a day-by-day basis. Together we are 6 individuals who focus entirely on the EMEA region, and the outcome of that is the first-hand experience that leads into a process that ultimately decides the stock, that ultimately allows us to build a portfolio of the stocks, integrating ESG along the way. The one aspect I've highlighted just before, which I think is very important, is this diversifying element that we believe investors in EMEA and investors in BEMO can use to benefit from. Then at the beginning of this webinar, Dan was highlighting the MSCI All Country World Index, and I chose this index to give you the following comparison. What you see here is a correlation. It's a rolling correlation. It's a 3-year time period over time of global emerging markets and EMEA markets relative to the All Country World Index, essentially the global equity market. And you do see, when you start from the top, the line in dark blue, you do see that EMEA and global emerging markets are relatively highly correlated. So, this would be not overly surprising. Both are, after all, EMEA is a part of global emerging markets. But if you look into a bit more detail, which I have done on this chart, and you go then to the green line, which is the correlation of global emerging markets to global equity markets, you do see that global emerging markets provide some sort of diversification to global equity markets. So from the perspective of an investor in global equities, you could make the argument that you get exposure to global emerging markets to have a more rounded portfolio to benefit from the growth and diversifying aspects that global emerging markets bring to the table. But going one step further and looking into the more I'd say less communicated parts of global emerging markets, such as emerging Europe, Middle East, and Africa, and that's where BEMO operates. You do see, when you look at the gray line, which depicts the correlation of EMEA to global markets, that this is again bringing a bit more diversification to the table on at least from the historical perspective. And that's something that I find quite interesting, right? This is the combination of giving investors access to a part of the world that is not very well discovered yet, and where we find interesting growth opportunities that are not highly correlated to each other, therefore allow us to build a portfolio which we think has all the features that going forward will provide you with three things, or will provide shareholders with three characteristics, that being growth, a yield pickup, and a relatively low correlation to global risk factors, and therefore hopefully a broader diversified portfolio as a shareholder. I talked about, so this brings me from the diversifying elements of EMEA equity investing into the growth opportunities that we see. So we do know about the growth, the high growth that we expect from various parts of Asia. It's a bit less known what growth pockets we do see in emerging Europe, Middle East, and Africa. And I wanted to use this slide to make you aware of the growth opportunities and sectors where we see substantial growth opportunities. I picked two, I think, straightforward elements of daily life. The first one is more traditional. This is new car sales. It is, I think, your classic discretionary household consumption item. It's also the largest ticket amongst discretionary items for most households. And I've highlighted, development in new car sales across various regions. As a comparison, I put the UK in there too. I've indexed, and this starts in 2007 and leads to this year, and it highlights the new car sales per 1,000 capita. You do see, for example, in the UK last year, or in the last 12 months, there were about 28 cars per 1,000 capita sold. This is a line that is, of course, impacted by the pandemic, and it will bounce back again. But essentially, it hovers more or less around the 30 level for quite some time now. And emerging markets, of course, have the tendency to catch up with that over time. And I provided a handful of emerging markets in this left-hand panel to be able to show you how this evolves over time. And we can say that it's not highly correlated. Right? I can see that. First of all, we can see how well China has done in the past. So it has tripled. And I think that this goes to show that EMEA markets such as Russia, Poland, Turkey, South Africa do have substantial potential going forward to deliver on that front, continue to deliver on that front. And you also see how different and uncorrelated these lines are to each other. So yes, they are growing over time, most of them at least, but they're growing in an uncorrelated manner. And I think this goes to signify what we highlighted at the past, that this is quite a diverse kettle of fish, but they're all interesting, so to say, and provide us with stock picking opportunities, and in combination provide a very nice diversifier for anyone's portfolio, I believe. On the right hand panel, this is takes you into e-commerce, also by now an element of daily life for all of us. Not so much in other parts of the world where we see a rapid increase in e-commerce penetration. This is measured as percentage of the overall retail market. And again, you can see actually where China already has gone, right? And we think this is a bellwether, so to say, of what is here to come. I mean, the UK is certainly also leading within Western nations, but you do see how Russia or Poland are lagging in this aspect. And this is again providing us, we think, with an indication which direction the travel goes, and on that way we think we can benefit from this catch-up potential by investing in quality growth companies that will be positively affected by this trend. So I've talked about the diversifying elements. I've talked about the growth potential that we see in this vast region, and I'd like to highlight the income element, something that I think is very important too for investors, especially since I highlighted that this is not being based on a compromise. Normally, you need to compromise whether or not you want to go for income or you want to grow. And what the message that I want to leave here with is that EMEA is, from my perspective, one of the regions where you don't necessarily have to do that. And this chart goes to exemplify what trends we have seen in the past, right? So this is the underlying dividend generation in a couple of EMEA markets, and by comparison, also in global emerging markets. And I've indexed that to the 2010 dividend generation to give you a view on how dividend generation has, or how dividend payouts have been developing over the last couple of years, over the last decade, essentially. And the outcome is actually quite interesting, at least from my perspective. You see that overall in emerging markets, income hasn't changed a lot, so dividends have gone nowhere. So they are exactly at the same level in US dollar terms where you found them 10 years ago. So it's not a big dividend, hasn't been a big dividend story. But in EMEA, the situation is a bit different. You do see how positive dividend generation has been developing in some markets, and how disappointing in others. And it's interesting that global emerging market, and that's the gray line just in the middle, acts as kind of a watershed between the have and the have-nots. And the have are certainly led by Russia, which has seen a fantastic development on that front, and that's based on companies becoming more professional, more efficient, generating the same growth with becoming less capital intensive, and therefore and focusing on corporate governance, therefore allowing a higher distribution to shareholders, and that has translated into much higher payout ratios. And therefore, even though the EPS, the earnings development, was nothing like that, the dividend development was much better. That's in a nutshell what happened in Russia. And in other markets such as Poland, which had benefited from a very strong economic growth and a lot of inward investment into its manufacturing capacity, but also in the consumer sectors. We saw other elements that impacted that negatively, such as government regulation, higher taxation, and so on. That led to quite a disappointing development. So again, right, this is a very diverse backdrop. This is not one story, this is many stories, and this allows for active management, we believe. That's where we come in, and where our expertise hopefully makes a difference going forward, as it has in the past, as is best exemplified, I think, by the long-term performance numbers of BEMO on an absolute and relative perspective. How this will eventually make a difference is highlighted on page number 8. A difference, I mean, in income generation. On this slide, you can see the underlying dividend distribution of BEMO. I want to say at this place that the board of this trust wants to pay out the highest amount possible. So the income is normally translated one-to-one in dividends and therefore reflective of the underlying income. You do see that on the dividend per share. BEMO has, I think, delivered a very successful history so far, where we've grown the dividend from the single digits well into the 30s per share. Clearly, the pandemic has left a mark, as in any other market and any other product. But I want to say that I see no reason not why dividends shouldn't bounce back from here. You already saw at the previous slide this V-shaped recovery in dividend payments across our major markets. So going forward, I believe that by 2022, the underlying income generation will bring us back into the 30s again, which is an all-time high. And I'm not so much focused on the dividend yield because I'm focused on the dividend per share. Of course, I'd always like the share price to go up. So, the dividend, the yield is not something I can directly influence. What I can directly influence is the dividend per share. So the message that I want to leave the audience here with is that we think that, firstly, we are going to bounce back well into the 30s in dividend per share. That at the current share price would take us into a dividend yield of 4% plus, which we think is quite strong. And we think that this is not only a sustainable dividend per share, we think is actually growing. I think this is the message here, and this encapsulates what I said before best. I believe this is a trust where you don't have to compromise between income and growth. We think we can deliver both going forward too, as we have in the past. Now, since I highlighted the diversifying elements, the growth elements, and the income elements, which are, I think, the bedrock of the investment rationale in BEMO, let me not forget to make you aware that the global thematic elements that drive growth, and as we see it right now, are well represented in this portfolio too. So whilst a lot of those company names that are in our portfolio are not very familiar to you, or probably not very familiar to you, you will certainly be familiar to a lot of these thematic elements that drive the underlying business development of the relevant companies going forward. So we are exposed to global trends. We are not avoiding them just to generate income. No, this is a portfolio that we think is exposed to the right global trends and that can generate an income on the way going forward. Some of the companies that are that are important to the portfolio, that make up an important part of the portfolio, are highlighted on the next two slides, and I'll just give you a quick overview on them. That starts with Discovery from South Africa. This is an insurer that has, we think, a very proactive presence on various developments. And some of you might be well aware of the agility concept, which is also advertised in the UK. So this goes to show that Discovery is led by management that tries to be creative and grasp opportunities in the healthcare sector going forward. We believe that insurance is undergoing a lot of crucial changes going forward, and this is a company that is future-proof. We believe in that from that perspective. This takes me to another South African company, is Anglo American. So here we talk about a global mining champion that we believe is going to provide the global economy with crucial commodities that are necessary for energy transition, and copper and the platinum group metals, the PGM metals, are the best example of that. So I think this is a company that will benefit from its vast asset base in commodities where we think, that we think form bedrock to a cash flow generation and growth profile going forward. Moving from SA into MENA, I want to draw your attention to Al Rajhi, which is an important holding in the portfolio too. This is the leading bank in Saudi. we think it benefits. It is going to benefit from various positive developments. On the one hand, clearly a bit more attractive interest rate outlook for US dollar assets, and after all, Saudi is linked. Saudi Riyal is linked to the US dollar. Provides it with a interest earning potential going forward. But more importantly than that, we think that its extensive network of branches and therefore this cheap access to deposits, give it a head start in loan growth going forward. So this is certainly one of the key advantages of Al Rajhi going forward, and we believe this will express itself in superior EPS growth in the upcoming years. Now, if you move now away from the Middle East and focus on the emerging European components of our portfolio, the three stock picks that you see ahead of you are from Russia, Turkey, and Greece. So again, very diverse economies, different currencies, different political systems, but interesting companies in every single economic backdrop. Here, start with Yandex, kind of best described, I believe, as the Russian Google. Here we've seen a company, that's in so far outstanding as it has from our perspective in the past really shown that it can compete with Google in terms of functionality. I think that's of course always easy said, right? But I think it's really, if they stood the test of time insofar as the consumer had a real choice in Russia in the past. I think that's very important to highlight, right? This is very different to other markets where Google was shut out from the beginning on. Yandex actually had to fight for its market share, and it did successfully so. Also in a period when the relationship between Russia and the US was a much better one, and I think that's essentially it was a baptism of fire for the company that created, I think, an entrepreneurial sense that you can still feel today, and the focus on the customer that is quite unusual for a non-US tech company from my perspective. So that's certainly, I think, there's a DNA in this company that will allow it to grow relatively strongly, and we are of the opinion that the valuation also stacks up very favorably in this particular company. The next one is BEMO from Turkey. I think this is again best described as the Aldi of Turkey. I think it's they are shamelessly copying the concept and have been doing so very successfully for almost 2 decades now, and there's still no end to the growth story here, and that's quite amazing too. It's a very organic driven growth story, as you can imagine. It doesn't require a lot of capital. It's very capital light. A typical store costs less than $50,000 to construct, and the entire working capital is provided by the suppliers. So this is a very we think attractive growth concept going forward with very high returns on invested capital that are being turned by management into successful growth. Lastly, Greece. That's probably a country that you haven't heard for a long time as part of a portfolio. It's an important part of our portfolio. It's just got upgraded, so in term from the rating agencies recently. I think this goes to show how much the company has changed from the dark days of Syriza and chaotic government, capital controls, euro crisis, you name it. I think it's almost becoming a poster child of reform. It's one of the few European countries where you actually can tell a positive story from the perspective of how governments have evolved over the last couple of years. It's very pro-business minded, but it got, I think, the general population behind too. Guess why? Job creation, and we do see a pickup in foreign investment in Greece, and the The best, I think, example of that was the recent investment of Microsoft that opened its third European research hub in Greece with a multi-million investment. Now, how does National Bank of Greece benefit from that? First of all, we think its portfolio, which is burdened by historic liabilities, will look better going forward, and the National Bank of Greece will be able to rid itself of these liabilities. So it's a story of reorganizing the balance sheet. We think quite successfully. We think faster than the market has originally anticipated, and then focusing on the resurgent growth of the Greek economy and allowing to participate in the growth by doing its prime business, which is extending loans to households and corporations. So this is the reason why we invest in National Bank of Greece too. So this is the last slide. Sorry that I kept you so long. These are some of the basic characteristics. I might invite the audience to have a look on the webpage. That's bemoplc.com. And if you want, you can also sign up to our newsletter or contact us directly too. We're always happy to answer your questions and get questions from shareholders. So please do engage, think about investing, and if you have questions, forward them to us. Thank you very much.